This is the Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoy this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Mark Peter Davis of Interplay Ventures. Mark, thank you for joining us.
Thanks for having me.
So can you tell us how you got into early stage investing?
Yeah, I think for me, my story really starts at childhood. I am a lifelong entrepreneur. It's not something I picked up when I was, in my 20s. It wasn't a real strategic career choice. It's something I've always felt compelled to do. I think it's as much hobby as it is career at this point. I started out in elementary selling baseball cards, candy in junior high, computers to graduating seniors in high school. It's always been just kind of part of my wiring, for better and for worse. And I say that because when you're not good at entrepreneurship, when you haven't figured out the science of the process, it's a really hard path because you're met with a lot of failure. But when you get the knowledge, experience, and the method down, it's very rewarding. And so later in my career, kind of things started to come together and the pieces fit. Coming out of college, I did a couple of cycles through kind of the traditional corporate path. I did 2 consulting jobs, landed in a couple CEO roles, and along the way, knocked on a door of a venture firm in New York and started interning. And I started actually interning before I went to do my MBA at Columbia. I worked as an intern during my MBA program and then joined full-time after. And that was kind of my entree into the venture game. And so I ended up working at 2 different VC funds in New York City before starting Interplay and going off my own.
That's great. So tell us more about Interplay. What exactly do you guys do and how does it work?
Interplay has 2 sides. The first side, which is pretty traditional venture fund, we are focused on seed to Series B, high growth IT companies, primarily in the United States. And so we've had the good fortune to be in a bunch of great companies that have been rocket ships, some that are more known than others, but across the board, a swath of great entrepreneurs and some really exciting companies. That's the venture side of the house. On the other side, we are a foundry. So we're actually a company that builds companies. We have an idea, recruit a CEO, and launch companies serially. We have 14 companies actively in market today. The stats are something we employ something in the tune of 300 plus people. The companies that we started out with, we built a batch of about 10 companies that provide the core services businesses need. And we started out by selling those to a focus group of startups. So those include, we support a law firm that we're friendly with. We have Founder Shield, which does commercial and health insurance. Firon Marketing, which does digital marketing services, Bristol Palmer, which does outsourcing, so helping people with customer service, data entry, et cetera. Benwise, which is a curated community for leaders to kind of help each other with personal development and growth and management decisions. Green Park, which does facilities management, actually cleaning people's offices and keeping the lights on. 20 Pine doing recruiting, and Nomad Financial doing accounting, taxes, and what they call tailored finance, which actually sets up financial functions in companies and brings in part-time CFOs, et cetera. Those companies, I think, in aggregate, are collectively the largest provider of services to venture-backed companies in the United States at this point. The stat we toss around is something like 1 out of every 10 venture-backed company in the U.S. uses one or more of those services, and those range from some of the biggest names we've all heard of down to a couple folks who are starting up and figuring it out. So we went out and built that platform, and there was a couple of reasons to do it. It was a business opportunity, but services businesses are probably not the sexiest business line to be in. And you think about most VCs are not out chasing building an accounting firm. But I thought there was a pretty important social mission to it, and that I felt that the startup community was materially underserved. And if you believe that exponential change actually happens in the way we kind of evolve our society, and that the innovation economy, entrepreneurs, by definition, are advancing the quality of living and the standard of living of mankind. The idea that we can make these companies even 1% more effective or 1% less likely to fail on an exponential basis could have material downstream impact. So a lot of reasons to do a good business opportunity, but also really wanted to have an impact on the startup community. And the last reason was we planned to build a bunch of companies over time, and we wanted good services to exist. We simply just wanted to use them. So went out, built that. We've built a few companies beyond that platform now. But of the 14, I believe 10 sit squarely in the B2B service line. And people can find that on interplay.vc/scale. The scale page actually goes into those different companies and gives people a flavor of the breadth of the clients.
So what kind of companies do you look to bring through your program? What is the minimum requirement they have to have? Do they have to have product market validation or be in a certain sector? But who are you looking to help most?
Yeah, so I've been doing the venture game for a dozen years. I think when it distills down to it, most people are looking for many of the same criteria. You'll hear the traditional things recited of great team, competitive advantage, big market, et cetera. We're looking for that. I think for us, we probably put a little bit more emphasis on product market fit and existing traction than other investors. Some people, will bet blindly on the right person, even without an idea. But we like things that are kind of in market, rubber on the road. We do get involved earlier, but there's a bias towards that, towards those proof points.
And do they have to have revenue to get in the door, or do you take pre-revenue companies? How far along down the product market path fit do they have to be before you'll engage?
We would work with pre-revenue companies, but we need to kind of know that the business is working, that the core assumption of consumers are going to buy something is happening. Look at a lot of the companies we engaged in are kind of the companies that we did that are better known, are like Coinbase or Warby Parker. But there's other companies that we engage those very early in their Series A rounds. But companies like a Burrow, which is a more recent investment, or a Kelly Network, are examples of companies that maybe were a little earlier in the traction side. Burrow had a fair bit of revenue. But Kelly's a good example. They were very early in revenue. They're a provider of video content online, but their user engagement was massive. So we knew that the people wanted what they were selling, what they were making. And that's kind of the thing we're looking to vet out.
Okay. In what sector and stage of groups are you normally looking at? Is it just B2B SaaS businesses in the tech sector, or do you do anything in healthcare or other sectors at this point?
Yeah, we're a generalist on the IT side. So we've done everything from media to crypto to furniture onward, educational products. It's all over the place. What we're looking for is less about industry. We're more looking for patterns and characteristics of companies that we think make them viable. But we wouldn't be doing, whether it's health tech or anything else. It's not about as much about the sector. We tend to stay away from things where you need a PhD to understand the viability of the product. So the way I like to say it is, we saw a cybersecurity play where it was the next best thing in cybersecurity, and you needed a PhD to know why it's better. We'd probably be less interested in that because we don't have the PhD to understand cybersecurity. But we're more likely to get excited about something that's easy to understand, like a marketplace for cybersecurity products, where we can look at it, understand what it's doing, understand the dynamics, see the patterns, and bet on that.
Well, it sounds like you have a great model there. I know many companies would just love to work on their core product and not have to worry about all these other things that go around running and growing a business. And it sounds like you have a great thing there. Have you ever benchmarked what the productivity of your program is versus the traditional way of everybody just putting their own finance and sales and marketing programs together? And of course, if it's the first time, it's got a lot of work to be made efficient and so forth. But any numbers you think you can put around it?
Yeah, it's the choice actually that people are making when they're thinking about outsourcing on these functions, where you're talking about accounting or legal or insurance or marketing. For most of them, not all of them, those functions usually, it's a choice at the early stage of just not doing them or outsourcing them. Right? It's the first-time entrepreneur who doesn't buy insurance because it seems like a waste of money, or doesn't do accounting and figures they'll clean it up in a couple of years and finds out maybe that they have tax problems or weren't paying into workers' comp or doing some other mistake that would be severely damaging. So I think what we find is people who have been entrepreneurs before usually sign up for kind of the core checkbox stuff pretty early on, get it out of the way. And in some cases, there is a point where companies get to a scale where they do have a build in-house versus outsource. For example, there's some finance functions when companies get to Series B or C where they might bring them in-house. Marketing is one where, just depending on the team's competencies, they may do it in-house early on or not. So a little bit varies by service. I think the biggest mistake, if I was going to parse a question from that I think a lot of entrepreneurs who are first-timers don't have their head around, is that getting your house in order early on is very worthwhile. The cost on a relative basis of these services, whether we're providing them or someone else, doesn't matter. It's all priced about the same, is well worth it because it's not going to make or break most businesses. It's not kind of a big line item. But having to deal with this nonsense and unravel it later, it ends up being a nightmare. Sometimes it gets in the way of financing rounds. Sometimes it leads to financial ruin of companies. It's just stuff that people should get done early. That's my advice on it.
Well, there's a lot of basic stuff that have to be done, like accounting and bookkeeping and tax and those are pretty plain vanilla. But then you get into other areas like sales and marketing where that varies widely from one group to the next as to what channel, what tool, what market, what position. And there's just a lot going on there.
Yeah.
Are you able to, get some synergy around your sales and marketing for a broad range of companies, or do you find there's just a lot of commonality between those companies and you're able to leverage that platform across a lot of companies in a more efficient way?
I think there's lessons learned that anyone who's an expert in the field who does something at scale sees patterns. But I think the key thing for folks when they're dealing with sales and marketing in particular is they have to understand what the objectives of each stage of financing are. If they're a venture-backed company, which not every company should be, by the way. I wrote a book on fundraising, and I spent a fair bit of time arguing in the first couple chapters that most companies shouldn't raise venture capital. And so that's out there. The book's called The Fundraising Rules. When companies are out at this stage raising their seed, or even before their seed, as kind of milestones move earlier and earlier as the market becomes more capital efficient, it's not about scaling. I mean, most people will go out, they'll raise their seed round and they'll think, all right, I need to make this as big as possible, and that will attract people to the A. To me, it's more important in the seed round to understand the mechanics of how the engine works and then use the money in the A to scale. I liken it to a car. The goal of a seed round, in my mind, very often is to actually go out and understand that when you put a gallon of gas in the engine, it will drive this many laps around the road, around the track. And then what you can do with the A, once you understand those metrics, is you can put a whole lot of gas in the tank. It's not about running as fast as you can and doing things that will get you as big as possible. It's about understanding how to do it consistently and scalably. And that has an important implication. There may be non-scalable ways to build your business in the beginning that you will have to phase out over a period of time. Relying on those methods to put big numbers up in a way that you can't sustain or make hay of when you raise more capital doesn't do you a hell of a lot of good. What you need to be able to do is take in that seed money or that angel round, whatever you got, and understand how you can efficiently deploy those dollars in a consistent and predictable way. Now, there's a mantra out there about doing non-scalable things early on. That's not actually in contrast to what I'm saying. It's not a contradictory statement. Very often, understanding these KPIs, these metrics, requires non-scalable activity. What that means is instead of hiring a marketing person in-house, it might be working with 3 different marketing firms, a CEO on the front line trying to figure it out, trying to get all the nuances of what's happening, talking to customers. But the goal isn't to make the biggest company as quickly as possible at that stage. It's to understand how the engine works very well. And once you understand the engine works, it's very easy to scale. And so understanding the segments of the milestones of this venture conveyor belt, I think is very important and actually leads to a tremendous amount of capital efficiency because you do make different decisions in how you spend your money if you understand what the real objective is. The objective in the first phase is to build something. The objective in the second phase is to understand exactly how the mechanics of it work. And then it goes into scaling in one region and then other regions. It's kind of a typical pattern. And that kind of maps up with angel seed A and B.
So you see a wide range of entrepreneurs coming in. I think some people are auteurs, they control everything. Others are just very specific to their product or niche or their customer. What kind of entrepreneur does best in your format and in your structure?
Can you ask that a different way, just to clarify?
Well, there's many kinds of entrepreneurs out there, and I was just trying to figure out which ones are resonating best with the model you're putting up. I know some entrepreneurs are, I think, more controlling, and they want to control every aspect of the business, and others have a different view of the world and want to focus on just the product that they want to sell, and they don't care about the finance and all the other pieces that go around it. So I didn't know if there was any type of entrepreneur that you thought does best with your model over some other time.
Yeah, and just to clarify, for us to invest in a company, they don't have to be using our services. So it's not an inherent model. It's more just there's a menu. It's a platform.
Oh, okay.
But I would say my mindset on that is that all types can work. But generally, increasingly, there's a pattern of, and I think it's probably the general wisdom, of CEOs and founding teams and early employees focusing on doing things that they're really good at, that they need to be specialists in to deliver their service with things that make it exceptional, right? If they're building a new type of shoe, making an incredible shoe is mission critical. There may be a bunch of things like insurance for shoes or legal that are things that they don't necessarily need to be experts on, but they need to make sure they get done right. My view is that no one's Superman, and you need to have lots and lots of resources around you to fill in all the gaps and make sure every gap is done by someone who's really incredible at what they do and has some wisdom and can provide good advice. Generally, I see the most successful people going outside of their organization to bring in the right resources. Now, when companies become enormous, 1,000 employees, of course, a lot of these functions end up being in-house, not always being in-house, but in the resource-constrained world of startups, you're looking at Series Angel, Seed, A, B, C. You see increasingly a lot of these functions being leveraging outside parties. I think that's been a consistent pattern over the last 15 years.
Well, it seems like you have a very efficient model there. And the final question I have for today is that what do you think the impact on this model will be on the return? How much more of a greater return do you think will come out of it because you're moving these companies through the process more quickly and more efficiently? So they probably need less funding to get where they're going. They can spend more time working on the growth and scaling issues, which is the core of it. What kind of number of return do you think might be the differential coming out of it?
I think the companies that plug into the services platform, whether we invest in them or not, end getting further on a dollar and avoiding common pitfalls. And the reason that I think that ends up happening is every company out there needs good service providers simply just to take friction out of the things that they just need to get done. The magic of what we're doing is that the companies we built are built by people from the entrepreneur community. They're people who have been in the fire, who have been founders, who have done these types of things. The culture of our companies are built the same way traditional venture-backed tech companies are built. And so when everyone starts engaging with these services, they're getting experiences and solutions that actually make sense for venture-backed companies. And that's the novelty. That's the unique value add. I think it takes a tremendous amount of friction out, and that's why there's thousands of companies using them at this point.
Well, that's great. Well, I appreciate your taking time to share that with us today. How best for the audience to get back in touch with you?
I'm easily accessible on LinkedIn. People can also get to me directly through our website, interplay.vc. We respond to everybody. That's kind of our internal policy and culture. So if people want to get in touch with me, it's pretty easy.
Well, that's great. We'll put that in the show notes and hope to have you come back and let's dive deeper into some of these topics that we have going here. Appreciate your taking time to talk with us today.
Thanks. Thanks for having me.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.